Hi friends, welcome back to the channel. And this is your daily news. So let's just jump right in. Look at the headlines. As Fed signals rate pause, Powell will have to placate the hawks. So the basic gist of it is, if you take a look at sort of the projections, the FOMC will make their announcement whether or not they're going to raise rates or not. Right now, there's a 73% chance that they're going to pause, meaning no cut, no rate hike, just stand pat. And there's a 26.4% chance that they'll raise by 25 basis points. So we'll keep an eye on that this week. And I also believe inflation data will be out as well. So we'll keep an eye on both of these things. One of the things that I want to mention with this is that it's interesting because we are raising at a pretty rapid pace. I mean, take a look at this chart here. This is in 2022. We've been raising rates. I think it's like 11 months in a row, something like that. You guys see right there. That's the black line. And you can compare it to other moments in history. This is actually pretty high. And it's pretty crazy that the market has been bumping the way that it has, considering that we are continuing to raise rates and most likely we'll keep that elevated through the rest of the year. That's sort of what the bets are on. Read more headlines here. You guys see this? Red will keep rate hikes thanks to inflation fueled by corporate greed, investors say. And basically, Bloomberg does a survey asking, people, what do you think about the market? What do you think about companies? Are stocks cheap or expensive, etc.? And one of the questions that they're asking is, are companies making more money today compared to yesterday? And I'll show you guys some charts here. But question is, are companies profiteering? Like they're essentially making too much. And one of the things that we talk about a lot on this channel is that companies are either charging people too much in prices or not paying their workers enough to essentially profiteer, right? So if you ask people, yes, is that the kind of the answer? Yes, companies are profiteering. Another one is, should central banks keep rates high to quash profit-led inflation? And the market participants who answered the survey here also said yes. The interesting one that I have here is a chart. This is basically looking at profit margins. And these are in companies in the U.S., so non-financial corporate businesses, of how they are. And you can see that profit margins are elevated. You guys can see it for yourself here. This is a really interesting chart. So, we are higher than levels back in, say, the last, it goes back to 1960, this chart. So what was that? The last 50 some years, we are elevated compared to, historically. Now, to be fair, right, this has been the last 4 years that these sort of profits have been like this. Is that just the new trend, right? Are we essentially, setting a new bar? Because if you do look historically, you can see it is a slow creep up in terms of corporate profiteering. So I'd love to hear you guys' thoughts on that one. But you can also make the case as well that we certainly had, free money been printed out way too much for a long period of time. And will that come to an end? We are raising rates. And so this is sort of where, the control inflation, you got to figure out, okay, something's got to give, right? Now, the Fed has been saying they want to get the inflation to CPI at 2%. You guys know this. And they asked, again, the Bloomberg survey, what do you think? Is this possible? How soon will it happen? Within 12 months, only 8.7% of the people say that's a thing. 45% say it'll be within 2 years, and then 35% say within 5 years. And then you got 10% 5 years or more. So sort of the consensus is between 2 to 5 years, meaning that if the Fed is indeed serious about inflation, they should keep rates elevated. And I say if they're serious, because you never know with these people. And we always make jokes in this channel is that the Fed has already lost credibility as it is. They should have just raised rates and just, ripped the Band-Aid right off. But they are being cautious on this. So, pause is fine. I don't think they're going to be cutting. And sometimes you'll hear that every now and then they are, but it seems so odd to me that they would. My guess would be, sorting to everyone is saying, they'll keep rates at least through December at this elevated rate. So we'll see what it is. If you take a look at this one, this is actually an interesting one as well. Looking for cracks in the U.S. economy. And essentially what it is you want to look at, say, something like discretionary spending. And the example of this is Financial Times that they used was RVs. And it was really interesting because basically, if you're out and you're in the market for an RV, essentially no one is buying. This is 2023 here. You can see that, what is this, down 60 some percent. I believe this is year over year, which is pretty crazy. Now, RVs are certainly sensitive to rate hikes. So again, Be it how much money does someone have, how much money does someone want to spend on this kind of thing, and what our interest rates at. This is actually related in another vehicle-related thing, which is NIO. This just came out. I was just checking the news. NIO's cutting prices on all their electric vehicles by 4,200, which is quite a bit actually. And percentage-wise, if you guys are NIO fans, the ET5 is getting cut by 9%, 9.1 actually to be exact. ET6 by 8%, ET7, which I think is the cool one, by 6.6%, and then the other ones, ES7, EC7, EC8, all around 5 to 6%, but more like a 6%. So that's actually a big price cuts. I think they have a demand problem over there. And this is an interesting one as well because their earnings report, the last NIO one, they're basically losing more money than expected. So that's not great. If your company's losing money, more money than expected, and you're cutting prices, they think they do have a demand issue, right? The other thing too, which is really interesting, because you're putting all this stuff together, you're like, okay, should the Fed, be concerned about this? Because essentially is like, let's say, for example, that no one buys anything. Let's go back to the RV thing. In that regard, then you would want to, say lower rates to get people to be buying stuff and keep the economy flowing and making sure people have jobs and we're all buying EVs or RVs, whatever you want to say. But then you have a problem with inflation, right? So this is a difficult thing to solve. Take a look at something like this, like housing, because if you watch this channel, we talk a lot about commercial real estate. This is just basically residential. And evidently, according to these charts, you can look at these. These are all major markets: Atlanta, Boston, Columbus, Dallas, Miami, Milwaukee, Phoenix, and Seattle. The basic gist of it is that home prices are still elevated. And the argument they'll make is that it's due to low inventory. One of the things I thought was really funny, and I didn't know this was a thing, and I'd love to hear if anyone is ever seen this happening or happening in your neck of the woods. Evidently, you can read the headlines here, housing inventory is so tight that more shutout home buyers could end up building backyard homes. And the basic gist of it would be is like, okay, imagine that you got, room in your backyard and you're going to build a, essentially a 1-bedroom apartment / shed or whatever, like a small little home that someone can move into on your lot. So I'm not sure like how, that's why I said I'm asking you guys, I'm not sure how common of this thing is. They're just saying this is a possibility with inventory so low that we're just going to be, building second homes in our backyard and renting them out to someone else or outright selling it. Who knows? I think that was kind of a funny one. And the idea is that if the market is and / economy / consumers are slowing, then the Fed wouldn't necessarily need to keep raising rates because they're basically raising rates till something breaks, something slows down. One of the things that we're watching is delinquencies. So auto and credit card are ticking up a bit. Mortgage is ticking up a little bit as well. We're talking about delinquencies. But we're not at levels, say, like of the 2008, which is right here. You guys can see this right here. So this is where delinquencies were much, much higher. So yes, they're ticking up from the lows of 2020, but not quite the levels of 2008, which is when we had a recession. And this is where, if you want to make the case that we could indeed have, essentially a soft landing, that it certainly could be a thing, but this is something you want to keep track of. Because my understanding, and I know I read the same data over and over again, but it's worth reiterating. The average American is like 38.5% of Americans can't afford their daily expenses, in a sense, throwing stuff on their credit cards because food is too expensive, rents are too expensive, and your fuel is too expensive. So this is why you watch delinquencies. And I think consumer debt, I've been seeing the number thrown around, it's something like $1 trillion, something of that nature. It's like the highest in history. The other thing too, which I want you to think about as well, which you're going to hear a lot about in the news as, rates remain elevated, is what's going on with the credit market, meaning like, are businesses able to borrow money and is there demand for that? So according to this, so this is from loan officers of banks, and they're talking about either, large and medium companies or small companies, and like, are they coming in to ask for loans, et cetera. As the tightening of standards, meaning that, you make it tougher to lend out money, because, for example, if you lend out money and the company is, have really bad forecasts, or you're worried about the economy, you're really concerned that they can't pay you back. So you make it stricter to lend out money. The demand also goes down, right? So they're directly correlated there. So this is something they're going to be watching because one of the things that I've been seeing a ton of articles about, I'm not sure if it has, but I've just seen a ton of articles about a lot of different startups are failing, or the sort of startup, world is crumbling. So that certainly hurts sort of the innovation that we want to see in the USA. Be it ARK Invest, these kind of things. They always say we pick innovative companies, these kind of stuff. But you're probably not going to see so much of that. And this also reflects sort of the job market as well, because I think this is really interesting when you put all these things together. I saw this headline. This is the Port of Seattle. And I'd love to hear if anyone is out there. Evidently, I guess they're striking. It's the ILWU. And this is something that we've also seen in the WGA, which is out in Hollywood. And you'll see various workers' unions basically complain they're not getting paid enough. This is an important thing, because essentially we put all these things together, right? I show you guys on the news, and I want you to go through it with me. We as we talk about this, is that the way we price stocks or the market is, okay, our company's going to make money in the future. So we know that companies have high margins because they're essentially profiteering. And if, say, their profits aren't so great, then that would mean stocks wouldn't be so great, right? Because you're essentially pricing stocks on future cash flows / future profits that a company's going to make. Now, theoretically, if they do decrease their margins, then yes, stocks would come down, or maybe they're going to maintain profiteering the way that it is. That is anyone's guess. The other thing too, which I'm thinking about, is let's say you can't get any workers to come into work. So in this situation, the Port of Seattle can't get people to come in, and then they got to raise wages to appease the union. So that would certainly eat at your margins if you're a company. However, theoretically, you could raise prices, but I think you guys get to see where this is going. If I raise prices to keep my margins, that essentially keeps inflation elevated, right? And there comes a point to where prices get to be too much, to where demand slows. So for example, I just did a video yesterday, which I'm sure you guys saw, talking about tipping and sort of like, why do I want to tip on something that's already too expensive? Right? I'm already paying for a $10 coffee, and now they're asking me for a 20% tip on something I haven't even, consumed yet, nor do I know quite the quality. And this is sort of where something's got to give. And I feel like, be it our markets, be it sort of our situation of just going out to eat or just living our daily lives, is like, things have just gotten to the extreme. I don't know if you guys know what I'm saying. I mean, I just feel like everything's too expensive and I'm not getting paid enough. And this goes back when you look at the charts, because we've shown a lot of data on this channel before, to where wages haven't necessarily stayed on par with inflation, meaning that people, for example, the poor people just feel like, okay, eggs are shot through the roof and you're just not increasing my salary enough to pay for said things. And then ultimately, if we get to the point to where costs are just pricing out consumers, or consumers try to keep shopping. So for example, there was a interesting report. It was one of the airline CEOs was saying that we're going to be seeing revenge travel in the USA. The basic gist of it is people were so ticked off for being locked up all this time that they want to just go out to the malls, they want to go fly, they want to go on vacation, and they're going to be spending a bunch of money that way. However, chances are it's going to be on credit, and that's sort of why we're watching delinquency. So the reason why I mention all these things at the same time is I want you guys to understand that everything is connected. And part of the sort of like why we track the Fed and watch rates is because that sort of is an underlying baseline of like, how much does it cost to borrow money, right? Because essentially a lot of these people are doing this on borrowed time / borrowed money. And then you're also looking in the job market because you need a job to pay for said things. So again, we're going to be looking for CPI data this week to see if it's come down. All of the estimates are saying that it is going to slow, essentially inflation is slowing down, but not to the point to where like it's that 2% target. And then we're going to be watching the Fed to see what they say in terms of like, okay, what's their language? Are they intending to keep, rates at this level for quite some time, which was what they keep saying, or is there an outside chance that they will raise it? So if the CPI data comes in hot, meaning like higher than expected, there's a chance they could raise it, but as the market is predicting right now, about a 26% chance of that. So this has been your daily news. Love to hear your thoughts on any of these topics, and I always appreciate you coming back for more, and I'll catch you in the next video.